So in this presentation, we're going to be looking at the contribution of the auditing profession to the UK economy. So, firstly, we ask, what is auditing? By definition, auditing can be defined as an official financial inspection or examination of an organisation's financial statements to make sure that the records are a fair and accurate representation of the transactions within the organisation. So that means that the reports actually show what is actually going on in that organisation, it's not a lie. Auditing involves careful consideration and evaluation of information in relation to transaction data, so revenue and sales, our client testimony, communications between individual organisations, and also other observations. An audit can be performed internally and externally, which will be developed further on in the presentation, and also not all companies are required to have their financial statements audited. It's dependent upon their size and their nature. So, why is auditing important? From a general perspective, we're going to look at why auditing is important, but we'll develop upon it further on in the presentation. But at this stage, you just need to know that it helps organisations achieve their goals and objectives by measuring the company's overall performance and productivity. It helps present a reliable health picture of the organisation to the market, so other companies know what's going on and can work off that. It also helps against fraud protection, so detecting accounting irregularities. This is important because if a company was to get a fraud case, it could be very costly and also damage the representation of the company. It's useful to financial analysis, determining the value of an organisation's shares. This is important because if shares are overpriced or underpriced, then it can affect the equity amount of that company and also its overall size. And then lastly, it helps investors make smarter investment decisions. Again, that ties into the previous point I've said. Essentially, auditing is important because it helps businesses evaluate the risk associated with their current accounts. So there's a lot of legislation, as you can imagine, around the auditing profession. Again, this will go into further detail later on in the presentation. But if you're just looking at it now, there's a number of regulatory bodies that are involved with auditing. Most notably, any person that carries out an audit in the UK has to be a member of the recognised supervisory body, or RSB. There's a number of bodies within that body which is important to the whole auditing profession in terms of legislation. These include the ACCA, ICAEW, ICAS and the ICAI. They're responsible for ensuring high ethical and technical standards, and also they must be independent from the organisation, that's the auditor. The Financial Reporting Council is also another one. They're a regulator of corporate reporting, so in this sense it would be the audit reports that they will be focusing upon. There's also the Audit and Assurance Council, which advises and supports the Financial Reporting Council mentioned earlier. And this is with respect to the codes and the standards, as well as research proposals and overall effectiveness of their work. In addition, there's the International Auditing and Assurance Standards Board, which is part of the International Federation of Accountants. This is more obviously on a global aspect. It's not really to do with the UK economy as such, but I just thought it would be nice to know. And then also the Generally Accepted Accounting Standards, which again is a bit of an informal accounting body, but it looks essentially at a set of rules which the auditors go by when auditing reports. So, as mentioned earlier, some companies, not all companies, are required to carry out an audit. Again, this will be developed upon further on in the presentation, but just to have a quick look at it, there's a number of different criteria and nature of companies that aren't actually required to do an audit. First of all is charities. Any charity can choose to opt out of a full audit, but they can do an audit if they want to. But most are required to obtain an alternative assurance service, however. So it might not be an audit, but there has to be another service whereby they check their accounts. Taken away from charities, there are also some companies that don't have to do an audit. As you can see, the table shows what constitutes a micro-entity, a small company and a medium company. And it looks at turnover, balance sheet, i.e. the number of assets, and the average number of employees. The highlighted areas, micro-entity and small company, those are the companies that don't have to do an audit. There's a number of criteria whereby a company can be classed as one, and in order to be one, you have to qualify for 2 out of the 3 criteria. So for example, if a company had 10.1 million turnover, 5.6 million in assets, but 47 employees, they would technically count as a small company because they are lower than 50 there and they're lower than 10.2 over there. And that therefore means that they don't have to do an audit. That's the same thing goes for micro entity as well. As well as that, there's also subsidiaries. A subsidiary is a company with voting stock that is more than 50% controlled by another company, the parent company. Subsidiaries are exempt if the parent company provides a guarantee of all the outstanding liabilities at the end of the financial year. So, for example, they're paying off their liabilities.
Hi, my name's Timur, and I'll be taking on the reasons of how internal and external auditing will have effects on management and shareholders. Internal auditing. Right, well, let's describe it as what it is. The Chartered Institute of Internal Auditors have described this as the role of internal audit is to provide independent assurance that an organisation's risk management, governance and internal control processes are operating effectively. Let's break this down into smaller statements. What is meant by risk management? Risk management in this statement is referring to the control a company has in place if there is any negative impact on the company, whether their plan is effective enough to deal with any of these situations if they were to arise in the future. Governance of a company stems from the board of directors who have the responsibility to act in the best interest of the company and allow for long-term success. Again, the board of directors are chosen by the shareholders at general meetings. There are many types of internal auditing, as you can see from the slide. There are financial audits, system audits, IT audits, value for money audits, environmental audits, and social audits. Financial audit is where an internal team within a company will look at the financial records of the company to see if they are in compliance with the regulations and are accurate. Systems audits is where operational activities are tested to see whether they're in synergy with each other as well as working in an effective manner. Internal IT audit is concerned with companies' tangible assets such as hardware as well as companies' intangible assets such as software. Value for money audit is where internal auditors will look at certain resources and compare them. Value for money audit is where internal auditors will look at certain resources and see if they can have a better alternative options and whether it is cheaper for the company as a whole to switch. Environmental audit is where a member of the internal audit team will make sure companies' activities are in line with environmental regulations, for example, carbon dioxide emissions. The final type of internal audit which some companies can undertake are social audits, and this will look at different stakeholders and what the effects of the business are towards them. For example, its employees, customers and suppliers. The second advantage for management of having an internal audit team is that it can allow financial records to be maintained on an accurate basis, which will undoubtedly reduce any accountability of the management team as well as detect fraud at an earlier stage without it materialising. The management team in itself does not have the physical manpower to look at every small details of any loopholes being exploited. Finally, having an internal audit team can benefit the company financially through cost savings. If external auditors think that the work of internal auditors of the companies are reliable, it will mean that it will take less time conducting the external audit, resulting in less fees to be paid. Internal auditing does not need to be in compliance with the regulations, which could lead to poor service being given if outsourced. Consequently, this may lead to an increase in cost for the business, as external audits may have to redo the work to the standards set by their company policies and national regulations, which again increases costs as more time is used by the external auditors, which increases fees to be paid to businesses. Internal audit can also be outsourced to an independent external team. By outsourcing the internal auditing, it can mean that it could lead to a compromise in flexibility, as they cannot be readily available in comparison to an in-house internal auditing team. The last disadvantage is that in an in-house team, they may produce results which are slightly biased, as again there are no legislations as stated before for internal audits to follow apart from being ethical. Okay, so the next part of this presentation we're going to be discussing external auditing and what it is. External auditing is the examination of a company's financial statement by external company. Due to this divorce of ownership and control, shareholders will tend to select the board of directors who will make day-to-day decisions. One of that decisions regarding auditing is that the board of directors will tend to make an annual appointment on the base that one decision regarding auditing that the board of directors will tend to make on an annual basis is to choose a certain company or a person to undertake the company's yearly audit. Once a full audit of a company is done, they will tend to issue an audit report regarding the company's financial statements, which is then issued to shareholders or any other potential investors. Within this report, the auditor will issue a statement on whether he believes that a true and fair view is given of the firm, and if all reports are made in compliance with the financial reporting frameworks. One difference between an internal and external audit is the fact that the internal audit regulation consists of. I already said that. Here we're going to be talking about the advantages of internal audit for management. The first major advantage for internal auditing is that it can allow for any discrepancy within a business to be picked up at an earlier stage and keep all operations activities being performed at an efficient and effective level, as internal auditing will make recommendations based on what they have seen. The second advantage for management of having an internal audit is that it can allow for financial records to be maintained on an accurate basis, which will undoubtedly reduce any accountabilities for the management team, as well as detect any fraud earlier on without it materializing, as the management team does not have the physical manpower to look at every minute detail of financial statements. One major difference between an internal and external audit is the fact that an external audit are subject to legislations regarding their rights and responsibilities, which are stated under the sections of the International Accounting Standards Act as well as the Companies Act 2006. Okay, so the next slide will tell us about the advantages of external auditing for management. One major advantage of external auditing, similar to internal auditing, is the fact that it can allow for any errors within the business to be calculated at an earlier stage. Along with checking the company's financial reports, the auditor also has to report on internal controls, which can be done through a walkthrough or a test of design and implementation by an employee. Again, if there are any misreportings within the financial reports alongside any fraud, it can be picked up on by the external auditing team due to their professional experience within the sector. External auditing is done by a completely independent company, so the report is seen as unbiased, which increases the reliability and the credibility of the opinion of the auditor. External auditors will need access to all the previous auditing reports which were undertaken either by themselves or a different company. Again, this is a positive, as it can allow for auditors to discover any errors previously and trends from previous years and act upon this on a concise manner. Okay, so alternatively, there are also disadvantages of external auditing for management. Auditing needs to be done on a thorough basis due to auditors having a duty to perform with great skill and care. However, in some cases, some audit may not have the time to be performed to a high standards due to either money or time constraints. Companies which are legally required to have an audit and submit it within a certain period of time will mean that there are certain audit tasks that will need to be prioritized. Auditors will try and meet the deadline set by the company for them, which may result in some of the work being rushed, which may result in certain important details to be missed out upon. The second disadvantage is the fact that audit requires certain employees to be interviewed or asked to give the auditor a walkthrough, which results in company manpower to reduce for the working day. This obviously leads to disruption, which results in the company to fall back in their work due to the whole auditing process. The final disadvantages of external audit is that most of the factors that the auditors report on are all financial, which means that non-financial factors are not focused on. So we're talking about the qualitative data. This could lead to a misunderstanding of the company's processes by certain shareholders, which may lead to problems. So we've talked about how external audit has affected management. Now we're going to be talking about the facts of how external audits have affected shareholders. Shareholders are the main people who elect the board of directors in order for them to perform in the best of their interest. Shareholders are the main people who elect the board of directors in order for them to perform in their best interest. Shareholders' main interest is to get as much dividends as possible, which will only happen if profits are being made by the business. The audit system helps the shareholders as reports are produced on how the business is being run and whether directors are doing a good job to keep costs low. If company is performing profitably, it may lead to external people wanting to invest within the company. However, if the company is underperforming, it can give the shareholder a choice of whether the money they have invested within the business, should they keep it there or whether they should withdraw it. It can also help them decide whether a new board of directors are needed in order to improve the company's position as a whole. Auditing also helps give assurance to shareholders that the board of directors are not only involved in line with their status. For example, if there is a non-executive director, he should not be involved in the day-to-day running of the business, and the audit helps assure the company and the directors that this is not being done, as it can lead to potential breaking of legislations which could lead to prosecution on the day.
As previously mentioned, statutory audits are required to be undertaken by all public listed companies as a duty owed towards their shareholders to ensure correct preparation of accounts. Companies who breach 2 of the 10.2, 5.1 and 50 employees are also required to undertake a compulsory audit and are classified as small and micro entity companies. Shareholders can also insist for a company to take an audit if they have over 10% of the shareholding in either nominal or number value. Companies who operate within the finance industry are also required to take an audit. This can be, for example, banking and insurance. This is also the case if their subsidiary whose parent company is part of the finance industry. Companies exempt from audit are required to provide a statement to HM Revenue and Customs along with the Companies House to say that they do not meet the thresholds outlined in section 477 of the Small Companies section in the Companies Act. This is also the case of dormant companies under section 480, which are companies that have not incurred any significant transactions during the last year. Section 499 of Companies Act outlines that the parent company is responsible for agreeing upon and guaranteeing the exemption in respect for the financial year. This covers matters such as liabilities and insurance that the subsidiary has not undertaken e-commerce actions. Audit exemptions are often subject to reform. Back in 1995, a company was considered exempt if the turnover did not exceed 90,000, 1.4 million in assets, and 50 employees. These were updated over time, and in 2004 the UK adjusted to follow the same thresholds as presented by the EU. Small companies who do not meet the statutory requirements threshold may find it beneficial to undertake an audit in order to improve the process within the business, and can see advantages of flexibility, independent review, consultation and verification to help with financial reporting. Flexibility. As the audit is voluntary, small companies have much more flexible arrangements when agreeing that audit. Small firms can, for example, use the audit to improve processes in the business. An example of this is systems auditing, when the auditing firm undertakes substantive and control testing to examine the efficiency, effectiveness, and economy of internal controls. Wage systems are often the case where an external viewpoint can help streamline the process, reducing the inputs which make way for human error and may cause potential problems. A non-statutory audit requires no license and can be undertaken any time to best fit the business and the budget. Consultation is important for small business who may not have their own finance departments and employees with specialist skills in that area. Auditors are often brought in to undertake control testing procedures as previously mentioned. For example, in payroll systems, we need to ensure and monitor payment of to HM Revenue and Customs on the pay-as-you-earn scheme, and ensure national insurance is correctly paid out of the employee's salary. We do not want there to be errors that would result in incorrect percentages being taken out. Verification. Small companies often do not have the resources, as previously mentioned, to have their own finance department. Having an extra set of eyes can help to make sure accounts are verified when handing them into HM Revenue and Customs and Companies House. Moreover, in order to obtain finance, it may be required that the accounts are produced to give greater understanding for the lending party. Compliance. Companies who plan to expand quickly may take it upon themselves to employ an auditor in order to build a rapport and understand the company's processes. That may be beneficial in the future when they surpass the threshold. By ensuring past accounts are verified and up-to-date data is kept, it helps to safeguard the company from running into potential legal trouble. Reasons for small companies not to undertake an audit: cost, time consumption, repetitiveness, and the compilation report. Undertaking an audit means having the burden of costly fees, which according to Brunel research, where 60% of small businesses believe these were too high and were not necessary, and the benefits were not worth the cost. Part of this is due to there being less companies meeting requirements nowadays due to the thresholds, which increase the costs. Small businesses with limited staff, and particularly management, will not have the time to dedicate to helping the auditor to undertake the processes required, such as interviews and guidance through how the company operates. As well as this, the questions are often repetitive and can be seen as intrusive, especially by companies who have no shareholders in order to report to. Lastly, since 2004, chartered accountants are required by their institute to...
I'll be talking about the implications of audit on the external economy. Normally, the role of the auditing profession is to give assurances that statements have been prepared to conform with the requirements of standards. This normally makes info more reliable and trustworthy for people using the information. The main role and function of auditing when considering the economic development in a country in broad terms is to produce information that enhances businesses and other stakeholders involved. This is because as a result of auditing, any decision taken by a stakeholder is normally taken when considering the information that is available. That being said, the quality of audit tends to lead to better quality decisions for businesses. A key component in making audits benefit the economy is that it's professional, highly skilled, and auditors are independent, as they help investors in public markets through separating credible from the non-credible managers. A business may look worthwhile investing in on the outside, whereas the audit report could paint a different picture on the inside. As a result of audits, information required to be produced in markets is systematized, regulated, and follows financial accounting standards. Therefore, as economic growth depends on the confidence of users of capital and the providers of capital, by building a basis for confidence, auditors can reduce financing costs and contribute to an efficient allocation of capital to fuel economic growth. Why reliability helps the economy. Normally, more reliable financial information is important in promoting investment and facilitating lending. Investors will feel they're able to make better informed decisions, and there is less risk involved if they have more reliable info to deal with. As a result, it will encourage more investors to part with their money when the information given to them is reliable due to the audits. If investment increases in the country, firms will have more funds to improve and their operations will expand. Furthermore, an increase in the productive capacity of the economy through investing in technology and capital results in long-term growth. This is as investment increases in the long run, real level of output which is sustainable given the current quality and quantity of economic resources. This shifts the long-run aggregate supply curve to the right. The implication of this is that as the economy grows in potential and actual and potential output without any inflationary pressure. In effect, the potential increase in investment therefore will lead to a multiplier effect in investment, where high profits will also lead to higher cash flow and more trustworthiness for loans and equity investments. The audits can also sometimes hinder an economy. When thinking about the flip side, the costs that incur in the audit profession may have a slight negative impact on the economy as a result. There are lots of fees and work hours required in preparing for and during the process of an audit. For big firms, fees can easily rack up. As a result, the audit has to be funded by money that could have been used to expand and increase output of the firm instead. For example, through investing in new technology to make the operations process for efficient cost per output. If firms did not have to incur these audit fees, they could become more productive due to having more capital to reinvest and therefore increase output that way. Whereas since 1st of Jan, like mentioned previously, an audit is required for firms with at least 10.2 million turnover and over 50 employees, meaning that the cost of auditing would have to be dealt with. The opportunity cost of this is that, like previously said, less money will be available to improve operations to be as productive as they could possibly be. If there are no audits, then there is a real possibility firms would be better off, as funds would be freed up to purchase more capital or train staff even further. However, it should also be considered that auditors in organisations who aid in planning and operations can make a company more efficient, as mentioned previously, and being able to compete more internationally. Being more internationally competitive means foreign countries will be more likely to import UK goods than domestic goods or from other countries. This improves exports further, and as a result, will cause injections into the circular flow of income. As a result, there will be an increase in national income. However, there are a few limitations when discussing the implications of audit on the economy. It must be considered that the demand for auditing is primarily to fulfill formal obligations rather than to serve its purpose in regular course of business. It should also be said that it's unlikely investors will rely solely on an audit report before undertaking a small or large investment, even regardless of whether it was audited by one of the big four companies. More likely, investment decisions are a result of comprehensive appraisal of a business in which the audit report is a factor, but there are many other variables such as studying annual reports or any other relevant information about a business and its securities. With this being said, audit reports do help in making investing decisions, but is not fully relied upon, so an increased investment cannot just be put down to the confidence increase through the auditing provided.
To conclude, the auditing profession is an important and essential part of the UK economy. Auditing holds benefit to the company that has its financial statements audited, as well as the rest of the organisations that make up the market. In addition, of course, managers, investors and financial analysts all benefit from properly audited financial accounts in different ways, all of whom I've mentioned are key components of the UK economy. So whether it be directly or indirectly, the process of auditing presents itself as a key contribution to the economy. With that being said, however, and as discussed in the presentation, the level of positive contribution the auditing process presents to the economy is hindered by a number of factors that need to be taken into account when assessing it as a whole. The three standout issues being time, cost, and potential inaccuracies. Potential inaccuracy, deliberate or not, is a big and significant one due to the devastating effects on an organisation and the knock-on effect to the entire UK economy. So, in a nutshell, it's important to consider both sides of the contribution of the auditing profession, but we as a group believe that auditing is an important practice with positive contributions to the economy that outweigh the negatives or potential negatives that surround it.